G'day and welcome to the program. My name's Andy Semple and I'm the director from share and options broker Andy. Today I'd like to talk to you about the buy-right strategy. The buy-right strategy is when an investor simultaneously purchases the underlying security and then sells options either at or out of the money representing the same number of shares. Another way to think about it would be like renting out your shares. Now here's an example of a buy-right we put together a little bit earlier. Now you'll notice it's talking about ANZ. So if you look at the third row, you'll see there that we've bought 1,000 ANZ shares. Why 1,000? Well, most option contracts are typically 1,000 shares per contract. So in order to write covered calls, you need to buy shares in lots of 1,000. Go to the fourth row. You'll notice there that we've sold one December 2009 $24.50 call option for around about 53 cents. Now, the 53 cents represents the options premium we've just earned by selling that out-of-the-money call option. Again, note the call option strikes $24.50, yet the purchase price of the ANZ is $23.73. The other thing you might notice too is that ANZ is also come dividend. They're about to report their interim financial results, and it would appear that the consensus in the market is that they'll probably pay a dividend around about 54 cents. So if you own the underlying shares, that means you're entitled to the dividend. So what we've basically done with this particular strategy is the following. We've bought 1,000 shares. We've then written an out-of-the-money December 2009 $24.50 call for which we've received 53 cents in premium. And now the investor just needs to really monitor the position and really wait it out until we come to expiry. Because when we come to expiry, only one of two events can happen. Either ANZ's above $24.50 or below it. Now, if it's above $24.50, then the option would be in the money and then therefore be subject to exercise, meaning the person who wrote the covered call would be now obligated to sell their 1,000 shares in ANZ for $24.50. If that were to actually happen, you'll notice on the table it says a return net of brokerage of around about 6.3%. If we analyse that out, it looks like a whopping 44%, but that's just, the magic of statistics. If we're not exercised or we use it as a standstill return, that is based on the purchase price of $23.73, the return comes out to be around about 3.6% after brokerage. Now, this strategy is also a very common one for people that like to use margin lending, and it's called a leverage buy-right. So if we now go to the second chart, you'll see it's the same trade as we did before, except this time we've bought 2,000 ANZ shares at the same price of $23.73, written two December $24.50 calls for 53 cents. The reason we've done it two times is because we've geared ourselves at 50%. That is, you, the investor in this example, have enough funds to buy 1,000 shares outright. You've then borrowed the funds to buy another 1,000 shares outright. Hence, you've bought 2,000 shares and then wrote two covered calls. Now, of course, the particular returns on this look significantly greater because you have introduced leverage. Now, there are a couple of things you need to be mindful about if you're using leverage. Obviously, the more you borrow, the greater the risk of a margin call. So you can see on this particular chart here that we've identified that ANZ would have to fall to roughly $15 before we get into a margin call. That's because we've geared ourselves in this example at around 50%. If you've never used gearing before but you're contemplating on doing it, I suggest that you speak with your advisor and you make sure that you go in at the minimum at a dollar for dollar level, particularly if you're on stocks such as ANZ and the other banks and BHP, etc., because that'll give you at least a bit of a buffer should the market get a little bit volatile. Now we'll wrap up with a few buy-right rules. Now these are important. Now there is a high chance that the buy-right will be exercised, so keep in mind the following points. Make sure that the premium that you receive is adequate compensation for the option being exercised. Remember the ANZ example? We're selling a $24.50 call expiring in December. Well, the options premium that we received was around 53 cents. So that's a decent sort of premium. However, if you're writing a call strike that was higher, say at $25.50, it might only be about 20 cents. So then you need to weigh up, is it worth me writing that particular call option just so I'm getting 20 cents in options premium? So be mindful of that. Another point, make sure that you're happy also with the price that you will obtain for the shares if they are exercised. Remember, in the ANZ example, we were selling a $24.50 call. That means that's the price you would be happy to sell the shares for. So if that strike price isn't sufficient in your mind, then obviously go to a higher strike. Now, do not use the buy right if you're not prepared to be exercised on the actual underlying share. So if you've written calls over shares that you think, oh, I don't really want to sell these now, then you shouldn't have done it in the first place. The idea is to buy the stock with the intention of being exercised as part of the outcome. You're happy for that outcome to happen. But also be mindful, don't go and buy stocks specifically to buy right because the current premium levels on the options are high. Be aware of reasons for higher than average time value in the options. That's usually a signal saying there's something a little bit sus in the market, and that's why the option premiums are so high. Just because the option premiums are high doesn't mean you should be going in there buying the underlying, because the underlying might not be the best, stock to own for the time being. And lastly, selling covered calls is a risk-reducing strategy. That's particularly important if you are about to do leverage buy rights, borrow the funds via a margin loan to sell covered calls, because at least you're going to generate some income which will help, pay down that loan or at least reduce your interest bill. However, resist the temptation to write naked call options. That means you're selling calls on shares you don't own. Now that is a recipe for disaster, and you don't want to go there. Thanks for your time. I look forward to talking to you in a month's time. Good trading.